Hello and welcome. In this lecture video, I'll review some additional example problems pertaining to variable and fixed cost behavior, and then I'll also discuss ethical considerations in managerial decision making. So we have this problem ProLite here, and this problem continues on the next page. First asks you to calculate incremental revenue. The next problem, dealing with the same exact assumptions about sales price since the same company, asks you to calculate incremental cost. And then the next problem over here asks you to calculate incremental profit. So here's what I want you to do. I want you to pause the lecture video and do these three problems, and then come back and restart the video, and then we'll check your work, okay? Okay, so welcome back. So our company ProLights plans to sell 1,600 white lights that enhance indoor plant growth, a total budgeted sales of $48,000, estimated profit of $8,000, variable cost per unit of $17.50. Customer A offers to pay $10,000 to buy 400 lights from ProLite. Fixed costs are $12,000. What's the incremental revenue? Well, there's no calculations that you actually have to do. It's just simply the amount that ProLite expects to receive from the customer, which is $10,000. That's the right answer, $10,000. It's given to you right there. What are the incremental costs? So it's the exact same setup. What are the incremental costs? Well, we know that variable costs per unit are $17.50, and we have to make an additional 400 lights. $17.50 times the 400 gives us to $7,000. The fixed costs don't matter. The fixed costs, $12,000 per year, they don't matter. They're not incremental. That's why they don't matter. Because if we make these additional 400 lights, we still have fixed costs of $12,000. We still have to pay rent of $12,000. If we decline this, and by the way, this problem is a special order, okay? If we decline this special order from the customer, we still have the fixed costs of $12,000. So regardless of whether we take this order or reject the order, we still have these fixed costs of $12,000. Therefore, it's not a differential cost, or the other way to say that is it's not an incremental cost. So the only incremental costs that matter are the variable cost per unit times the 400 lights, $7,000. So as we can see on the next page, we have that $10,000 in additional revenue, $7,000 in incremental cost, or $10,000 in incremental revenue, $7,000 in incremental cost. Incremental revenue minus incremental cost gives us the incremental profit of $3,000. Okay, that's the right answer. So let's talk about some ethical considerations with managerial decision making. So we talk about ethical behavior. We're talking about doing the right thing. Okay, we're talking about doing the right thing. And a lot of company codes of ethics are going to talk about what you can do and what you can't do. So when I used to work in industry, we would actually have to do some ethics training online. And so we would have to watch some videos, and then at the end we would have to certify that we know, for example, we can't take bribes, or we can't do any kind of kickbacks to different customers. So these are all the things that we are not allowed to do. And we've watched the training, and then we've certified that we understand this. We would click a button certifying that we understand that. And that was basically where we were reviewing the code of ethics. And the company would make you certify that you took the training, that you understand that. And to me, a lot of that wasn't so much, well, to make sure that you engage in ethical behavior and you know what's right and what's not right. Because lots of times in the pit of your stomach, you kind of know what's right and what's not right. If it doesn't sound right, it's probably not. But I think the reason that they made us take that training is so that if you did accept a bribe, you couldn't come back and say, well, I didn't know I was supposed to accept a bribe. The company could say, you took the training, you certified that you understood it, This isn't our fault. This is your fault. Okay. So that's why I think they wanted us to take the training. Maybe I'm a little bit cynical. But anyways, that was something that we actually had to do. The other thing, we come down here, we can focus on not just what's legal, obviously that's important, but also what's right. Because of the Sarbanes-Oxley Act, which was passed in 2002, there are a lot of provisions now to increase ethical behavior. Although I would, in my opinion, ethics is doing the right thing, even if you can get away with it. So saying it increases ethical behavior, maybe, but it does provide the incentives to do the right thing. I'll agree with that. So now we have to certify financial statements. There are certain types of work that auditors who make sure that the financial statements they don't contain any material misstatements. We also make sure that the internal controls are valid. Those are some of the tasks that auditors do. Auditors are supposed to be independent, and to make sure that they're independent, they can't perform certain types of work for their clients. So, for example, they can't implement a design and an accounting information system for a client that they audit. That doesn't make sense. Okay? Also, because of Sarbanes-Oxley, this is Sarbanes-Oxley Section 404, they have to produce a report on the internal controls of the company. Okay, so internal control, we've talked about that back in Accounting 101, but an internal control is a process, technology, or some type of procedure that you have to go through to make sure that our financial statements are reliable, that we have deterred fraud, and an internal control is also a mechanism or procedure that can help us improve effectiveness and efficiency. So it's some type of procedure that can help us reduce fraud, improve effectiveness and efficiency, and also make sure that our financial statements are correct. Okay? An example of an internal control here at Mary Washington is that if I want to go travel to a conference, I have to first get authorization to travel to the conference. And I have to submit in a budget for my conference. And that has to be signed off by the associate dean. So that's an example of an internal control. So when we talk about a framework for ethical decision making, I think one of the ones that I really focus on is this. Would I be comfortable telling my mom or my dad about the decision that I made? If I'm not comfortable, then it's probably not something that I should do. Okay? But there's some other questions here that I'm not going to read out loud, but you can think about when you're making some type of decision and you want to consider the ethical implications of that decision. But the one that I really focus on is that one. Okay? So I'm going to end this lecture video now, and then the next lecture video will introduce some concepts associated with manufacturing companies. Okay? Thanks.